Sure, we've got Eric Wilkinson. You may recognize Eric the Wolfman Wilkinson from numerous financial networks. He's an educator at Pro Trader Strategies and has been sought out by several media outlets to debate against some of the brightest minds in the industry. He is most notable for his comments in Rick Santelli's rant heard around the world.
Oh, yeah.
He was the first to use the phrase moral hazard in connection with the Fed's actions surrounding the financial crisis of 2008. So I've been looking forward to seeing you all day and hearing what you've got to talk about today, Eric.
All right there. Hey, Eric, how you doing, buddy?
Uh-oh, I think he's muted still. We have to get him unmuted.
There you go.
You got Pat and Nikki in the house. That's what I was doing.
That's what I figured.
In the pool house / workhouse. So
that's right. Yes, this is my home office. I'm not traveling like Kurt right now, but that is one thing I love about trading online. I was like I think you guys mentioned, I was a trader on the floor at the Chicago Board of Trade for about 20 years. And as soon as that started going online, one of the things I loved about that was trading from the computer. You can go anywhere you want, you know. One of my big things was the online trading. I was trading from the top of a mountain in Utah and literally punched in a trade right before I dropped in. So it was,
wow.
That is the fun thing about trading online for sure.
Outstanding. Well, it's great to have you with us, Eric. It's all yours, buddy. Grab the screen and go for it.
All right, great. Let me see if I can do all this myself here. So share screen. And I want to go with the rolly screen, I think. There we go, share. How's that? You're only seeing my stuff, not rolly anymore, right?
That's right. No.
All right, great. Thank you guys again for having me with you guys. It's always a pleasure. You guys throw a great event, and it's a lot of fun. So, especially in person, Pat and Nikki. All right. So anyway, this is avoiding the pitfalls of trading options. I'm not going to necessarily talk about your directional assumption or my directional assumption, but what I want to do is convey to you guys is there is a way with trading options that we can increase our probabilities so we can turn that table in our favor. So we don't always necessarily have to be directionally right in order to make money on these different assumptions. So that's the key I want you guys to really take away from here. And, you know, I do other webinars, even with Pat and Nikki, where I drill down on some of these different options strategies. Today, I want to just kind of glaze over that a little bit, and we'll talk about some of the basics in order to increase your guys' success. I did mention I traded on the floor of the Board of Trade for over 20 years. I started out trading in college with some money I had earned, moved to Chicago, traded in the pits. So what I wanted you guys to take away from that is when I was on the floor, I wasn't able to necessarily just pick the strategy I wanted. It was like we had to take the opposite of the trade that was coming into the pit a lot of times as a market maker. So I've learned from those pitfalls, if you will, of having to stand in front of a freight train when I really knew I didn't want to. So a couple of things to get out of the way real quick. You can follow me on Twitter at Wolfman's Blog. Our parent company is at Pro Trader Strat. Also, follow us on Facebook at ProTraderStrategies.com, where you can get all kinds of great free content. We're pushing stuff out all the time there. So this is avoiding the pitfalls of trading options. One of the things we do need to know before we start trading options and avoid those pitfalls is the Greeks. Now, hopefully you guys aren't all just like rushing out of the room right now. You guys are going to stick around just for a second because I'm going to make these things really easy to remember, hopefully, for you guys. Just some simple ways to keep in mind what these Greeks are and how they affect options premiums. What we want to know with Delta is it affects that option premium for a $1 move. And it's always assuming that we make a $1 move is higher, okay? So all of the Greeks are, the assumption is advancement forward, all right? Theta is 1 day goes forward, right? We got to remember that. And we can't go back in time with our DeLorean. So delta affects the option premium in relation to the underlying. So it's saying when the underlying moves $1 higher, how do we come up with that? So let me just pull up a platform here and give you guys a real quick, actually, I can do it on this one. So what we're looking at is the delta column on the calls and or the puts. Now on the call side, it's positive because I said it's an advancement forward. So if the underlying moves $1 higher, then over there in the options montage, which is just this page, we can see that our premium will increase by that 51 cents. So this goes from 296 to 297.07. Our premiums will increase by that 51 cents, all right? Vice versa over there on the put side, we can see that that's a negative. Now remember, a positive move with a negative delta, those are going to decrease by that 49 cents or whatever is correlated to it, all right? So a positive move higher. Now get those cogs moving in your brain. If it was a negative dollar move, right, a negative plus a positive makes that a positive. So if we move down $1, our put side would then be a positive delta, right? So it would add into it. And if it's a negative move over there on the call side, we could say that a negative dollar plus or a negative move plus a positive delta would make that delta now negative to those premiums, all right? So it would come out of it. So delta is that first dollar move, all right? Gamma here, gamma is basically dollar number two, all right? So if we moved higher by $2, okay? Or dollar number two. So gamma just goes with delta. So if you're ever wondering what gamma is, it just goes with delta, and it's an add-on. So when you're just looking at these option premium, you're kind of looking at your status on your what would happen, you know, the theory of what could happen here is now on that second dollar moves, you can see the gamma here, gamma goes with delta on the second dollar move. So that second dollar, the first dollar move we could see here, oops, I don't want to do that one. Sorry, I clicked on the wrong thing. I want to get this capture for my marker here. So we talked about this on the first dollar move higher. So we went from 296 to 297, right? 07. Our premiums over here on the call side would have increased by 51 cents. So we would have then been looking at 261, right? And then on the offer, we've got 51 cents going in there. So it's 21. Okay. So that's what our premiums would have been after that first dollar move. Now, second dollar move, gamma goes with delta. So now if the underlying was trading at 298.07, right? Now we have 52 cents adding into here. So the premium was on that second one would be 212, right? I'm doing this off the top of my head, so please bear with me, or 2173. Okay, so gamma just goes with delta on that second dollar move. Pretty simple. You know, the Greeks, they want to try and make them hard. As a matter of fact, I got your Greek symbols over here. Vega isn't even a real Greek. I stole this as a lowercase gamma number. But delta is data. Gamma just goes with delta. Goes with delta, right? Now theta is the thief in the night. All right, that's what we used to say, because overnight that theta thief comes in and picks away at our premium. He comes and steals a premium every night. Well, sometimes you want that to happen. Sometimes you want theta, that thief in the night, to come and steal your premium. So theta, we can look at it, is this little premium right here. You can see that closer to expiration, 16 days to 44 days, theta is a little less aggressive. So the further out in time we go, theta doesn't even really know you exist, really. You can think of it that way. But the closer it gets to expiration, theta's trying to take as much money as he can, all right? So theta, that thief in the night that comes and steals your premium, sometimes you want him to, right? You know, you've heard sell high, buy low. Well, the same thing goes with Greeks, all right? Theta being a thief in the night, well, if he's stealing a lot from you, do you want to be buying? No, you want to be selling. So theta, if you're thinking about, you know, selling options premium, or you're leading towards selling a call spread, selling a put spread, or any of those types of strategies where you collect a credit, well, think about it. You collect a credit, that means you sold high, and that thief comes in and just steals that premium, gobbles it away. Well, then you get to buy it low, even if the underlying trades sideways, right? You were directionally wrong in that case. Well, theta, that thief in the night, is coming and stealing your premium. He's helping you out. All right. So we aren't always right on our directional assumptions. We all know what assumptions are, right? Well, at the end of the day, what we want to do here with trading options is turn the tables into our favor. And this is one of those ways. So if you are leaning towards selling premium, you want theta to really be ramping up. So we always talk about as close to 35 days to expiration as we can get is where we would be selling premium in these different strategies. All right. Well, 44 days is probably the closest days to expiration on to 35 days. So this, what happens is we see theta, you know, he starts kind of eating away at your premium, then it starts really ramping up, right? And inside of 35 days to expirations, when that starts happening, all right, days to expiration, we really start seeing our premiums deplete. Well, if you're selling them, you want to take advantage of that. When you're buying them, you want to limit it, and you want to get out here, you know, somewhere in the 80 plus days to expiration. What I like to say is that's where you're buying premium, selling premium. You want to get real close to that thief in the night. You want to cozy up to him, right? All right. So, and theta, like I said, less aggressive further away, more aggressive near. Well, Vega is just the opposite. Vega is more aggressive further out the time horizon and a little bit less impactful closer to expiration. So Vega will spike further out in time and you know, contract rather quickly when that volatility comes in. And we'll talk about how that really comes to fruition here in just a second. I'll pull up the chart and everything else and show you guys some other interesting tidbits to it. So we can see the Vega now we're on. You can see it's a little bit less closer to expiration as in comparison to further away. But, you know, on the flip side, theta isn't as aggressive far out in time. So what we're talking about with volatility is this number right here, Vega. It's basically implied volatility. They just call it Vega probably because it's a V. All right, so this is talking about for 1 percentage point move. All right, so we've got 1 percentage point move. Let's say it's a positive because we're talking about advancement, right? So if this increased by 1 percentage point from 55.92 to 56.92, just to keep it exact, right? We got 1 full percentage point there. This volatility would then add into, oops, sorry, I hit my other button, add into the premium. So 1 percentage point increase, we would get a quarter going into this. So then we would see this puts being $13 even and $13.35, right? Okay, so you can see on both sides that Vega is positive, right? Because it's an advancement. If volatility goes up, all premiums go up. It's, you know, this isn't the VIX that we're talking about, although the VIX is compiles all of the volatility around each individual underlying. We want to really narrow down our search to what is volatility for this specific underlying, because volatility for Alibaba isn't the same as volatility for Procter & Gamble. All right. So what we need to do is, you know, split out all of the noise and really kind of drill down on this specific underlying to know where is volatility high right now. Well, I'm not saying go look over at the VIX and see volatility is pretty high for the VIX, or, you know, we're in the 20s or 30s in the VIX. No, what I want you to do is volatility isn't really created equal. We need to look at this specific underlying and see whether those premiums are expensive, right? Because if volatility is high, we know those premiums are expensive. If volatility is really low for Baba, well, we know those premiums are super cheap. So that's kind of what starts getting those cogs going again, right? It's that if they're really cheap, what are we going to do? That's where we would be buying options. And if they're super expensive, well, that's when we're going to be looking to sell those options. So just all of this is really just to get your guys' minds kind of working there, thinking a little bit of ahead. When do we sell options? When do we buy them? It's not just picking something out of the hat and watching TV. And I have friends, believe me, on mainstream media, and they're always talking about going and buying calls or, buying puts for their directional assumption. And it blows my mind, and these guys were floor traders too. But you have to know that they have to take everybody's risk parameters into account, and they don't know if somebody has a high risk tolerance, low risk tolerance. So a lot of those things, the people above that are writing the rules and telling us whether we're doing things right or wrong, SEC, they're the ones that say you can't really give that kind of investment advice. All right. So they just talk about their directional assumptions and then talk about a option strategy. Well, it's not always the right option strategy for that environment or what's going on around that specific underlying. So I kind of already got ahead of myself. I just start talking to the camera, I guess. All right, volatility, we buy low, sell high. I mean, that's pretty obvious, right? Whenever you're doing anything, you want to buy low and sell high. And we talked about this. Volatility is one of the biggest components of options pricing, in that it's the one that is going to fluctuate at any given time, right? We know delta is the one that just kind of clicks away for every dollar move. So we can see a dollar move higher or a dollar move lower. Well, we know what delta is going to do to those premiums, all right? We also know that every day goes by. So we know that that thief in the night just kind of clicks away at our premiums. Well, what we don't know is how volatility is going to kind of move back and forth. Do we? Well, maybe. Yeah, I think sometimes we can see when volatility for itself, it's just like a chart. If you look at a chart, you can see with your Fibonacci's, it bumps up against the Fibonacci resistance and, kind of pops down against another support level, all of those things. Well, I'm going to show you on some, I might as well just pull it up since I'm talking about it, right? I mean, why not show it? So let's just look at, we're talking about BABA. So for lack of a better example, let's just go with BABA. We can see here now, yes. All right, we got a massive spike there. That was the whole Corona thing. But keep in mind, these kind of spikes, like we saw, if I pulled up a chart of the VIX, which I guess I can since we're talking about it, the spike in the VIX, I always look at the VIX because I like to see where it's going. This kind of spike in the VIX, we haven't seen since 1987 or something like that. Even a bigger spike than what we saw back in 2008, 2009. So, one could say that this is a black swan event. When's the next time we're going to see this? Maybe another 10 years. I don't know. I can't answer that for you. But I do know that that is a major spike that we may need to take out of the data point at some point in time. Or let it roll off. But for this example, I'm going to leave it in there because we aren't out of the woods yet with this whole thing. Maybe it mutates or who knows what happens. I'm not one to predict that. But what we can say is that you can see that it has a tendency when it gets down at these levels, 23, 26 or whatever, that's pretty low, all right? And that it has a tendency to want to come back to about this mid area, right? Yes, last year that would have been a high, but I would tend to believe we have higher volatility going forward for probably the rest of 2020. So, and that's my assumption. You guys have to decide for yourself, but I'm just a talking head, right? I would say volatility is here for a little while, but having said that, do I think that we're going to see this much unknown in the market? For BABA, I think that that's probably a little out of the question, but just to say it could be in there, we can see that there is a point of where it wants to slow down on that volatility, but when that volatility comes out, it really comes out, right? We could say that just from the last couple of spikes in here, it spiked up to 51 or whatever, and then dropped down to 41. That's 10 percentage points. All right, so when we were looking at that volatility coefficient over here in BABA, 10 percentage points for this volatility, well, what's 10 times 40? That's $4, right? $4 for that, just that 10 percentage point drop in volatility. And if we looked at that chart, like it literally, it just traded pretty much sideways, right? I mean, a $4 out of that premium, I mean, I would have had to have a pretty big move in BABA. So the idea here is we want to be able to take advantage of that. You know, if I had a bullish trade on or something like that, and I had $4 come out of my premiums, I bought calls, well, that would have really hurt. One thing, you got the direction a little bit wrong. And when you're buying premium, you got the theta coming in and eating your premiums, you got the volatility coming out. All of those things are against you. You could have even been directionally right. And if that volatility came out and that theta came out because you picked the wrong month, well, all of those things being said, that could have really hurt your position, right? Say, for instance, I bought calls right here. I could probably do the math on it. I got the directionality right, but if I had picked the wrong month, the wrong duration, and that got that volatility wrong, that could have completely offset my gains on my, you know, directional assumption being correctly. Like somebody said, hey, you know, this is a buying opportunity, and I bought into that. That I could have lost money. So what we try to do is when we have our assumption, whether it's bullish or bearish, we go through some guidelines for you guys in order to determine what is the optimal option strategy for that assumption. So we're going to look at these internals like volatility, determine whether that's one of the main components. Like I mentioned already, volatility is the major component of option pricing. That is a fact. Yeah, theta's in there, but that's the unknown that we got to figure out is, all right, is this right now at 54 high or low? And we can't just, one thing I want to mention is we can't just pick 54 as being high or low, because I could go over to like Tesla and look at Tesla. Like, does Tesla ever even get below 51? Well, we could say in the new world, it doesn't. 62 is the low, right? And that's still Vega. If I go over to here, that's still Vega, all right? So we need, that's one of those, back to what I was talking about earlier, is we need to kind of discern where Vega is in relation to where it's been in the past for this specific underlying, all right? You know, I mean, Pepsi rarely gets up into those 50s. You can see, yes, it did back here during that whole Corona thing, but, you know, for the most part, to get up above 50 is a real struggle, especially before the new world order of volatility. But right now, you know, in the 20s, yeah, it is where it's at. So we could look at MGM being in the 74s, right? So we have to know where MGM has its volatility now in relation to where it's been in the past. Now, how do we determine that? We determine that by, well, I got ahead of myself again. Volatility, I talked about this earlier. This is how far ahead I got when I was chatting with you guys. Big is the change in the option pricing for 1% point change, right? Just to reiterate that. So we saw that for BABA, that 10-point decrease, right? 10 percentage point decrease, that starts really adding up. 1 percentage point is almost nothing. As a matter of fact, to go back to that almost nothing move for BABA, we could see that it probably changed from yesterday to today. Basically, this is yesterday's implied volatility, right? It was 50, it moved up 4 percentage points, you know, and for that 40 cents, let's call it, that's $1.60, right? So premiums, despite whether or not you were picking the directionality right between yesterday and today, where it didn't really end up going anywhere, premiums increased in BABA by $1.60, all right? That's a pretty good amount, you know, for it really closing only $2 lower, right? So we can take advantage of that, that volatility expansion and contraction, which is really where we want to go with this stuff. Oh, I changed the slide underneath. All right, so knowing when volatility is high or low for an underlying is paramount because that's going to determine whether we're buying or selling. Now, this is one of those talking heads, and I don't necessarily want to throw this guy's specific name under the bus, but, and this is a really old article. I'm not trying to just cherry pick, but they do bring this guy back around earnings quite often. But this guy is basically saying, go out there and buy calls across the board for earnings. Now, one thing to know is when we have earnings, that is one of the times we understand volatility is at its highest, is almost before every earnings call we have volatility really expand because that's the unknown. Keep in mind, volatility really is a fear indicator as much as people don't really say it is. It can be a fear indicator from buying calls, right? If people are buying calls left and right, they've got FOMO, fear of missing out on the upside. So that spikes volatility. It's a product of people buying premium, and those premiums uptick, more buyers than sellers. So missing out on the upside FOMO is as real as fear of protecting my gains and worrying about the downside. So we get volatility spikes on rallies and pullbacks, no matter what. So what we do know is heading into an earnings, we do get those volatility spikes happen. And then after the news is out, that volatility crushes. So to go out and just say, hey, this is my favorite option strategy is buy calls before a data point. I've showed in several different webinars that volatility comes out dramatically after that event happens. So we can see volatility crush happen right here after that event. We can see the volatility really comes out after that event, heading into, it's hard to say right now with the corona, but we can see volatility after the earnings. We start getting that volatility down slot. Well, if I mentioned, if you bought those calls, even if you're directionally right, you can see that money really evaporate quickly. And you're fighting an uphill battle. I mean, wouldn't you rather roll that snowball downhill? All right. Also, Rolly, if you see any questions popping up as I'm going along, I've got my little questions and answers thing over here, but I think I've got the wrong one up. All right. So this is how we determine whether implied volatility is high or low. And you guys can easily write this down. I also have script for TD Ameritrade Thinkorswim platform that really just runs this through to the exact number. You can look at that chart that I have for implied volatility and kind of figure out this whole implied volatility percent. And all this really tells us is where is current implied volatility in relation to the high and the low. So what we want to do is determine through this math problem, is it at the higher end or is it at the lower end, right? So what we can do is current IV minus low IV, high IV minus the low IV. So let's go back to this implied volatility of BABA, and we can see, I can't do it straight line. All right. Arrow options. Let's see if I can do an arrow real quick. All right, never mind. I'm just going to do a line. All right, so we can see right here, this line basically lines up right here. I'm going to call this 73, and I believe from checking it was 73, all right, or 0.73, all right? And I'm talking about percentages, so, we know that when you're talking percentages, you just multiply it by 100, right? And that's how you get your percent. And the low down here, if we drew that line, that's right around 23. 23 ... All right, I'm going to chop it off. I'm not going to round up or round down. I'm just kind of trying to make math easy here. So what did I say? It was the current IV, right? Current IV minus the low IV, and I'm not going to write it all out for you guys, but you guys get it. Current IV minus the low IV, high IV minus the low IV. Because you can see what I'm doing here. I'm just getting the range right here. That's the range between the high and the low. and the current where it currently is in relation to that low as well. So current IV I said was 55 minus the low, which is 23, right? And then the high is, what did I say, was 73 minus the low, which is 23. All right, we got to make those sums, right? So now we've got 32 divided by 50. Well, that equals 64%. All right. So it's in the 64 percentile, and that's even taking in this huge spike up here. All right. We don't always know. Now, sometimes keep in mind, if it was up there at 73, you know, just like back here in the day, you know, that was a pretty high implied volatility for BABA. It doesn't mean that once it's at an elevated level, it's always going to go, you know, straight down. Sometimes it does uptick. So you could have it at 100 percentile, right? And if it upticks again, you're still at 100 percentile. That's one of the problems with this equation, but nothing is perfect. Just like if it was at its low and it downticked, well, it's at its lowest level now. That's something we can't avoid. One thing we do know, though, is that once it gets down there, like it did, you know, it never really got below this level, but of course it did downtick a little bit, albeit those incremental down moves are going to be much less. All right. We're not getting 10 percentage point drops below those lows that we see kind of like here. You know, this is kind of the area where I would think that it's not going to go much below. As a matter of fact, I would think the area where it's probably not going to go much higher than that is probably 60 would be my thing. So 5 percentage points higher is where the extreme level in my eyes would kind of be for this particular underlying. And that's
hey, Eric, just a real quick question is coming on this. I want to make sure we don't lose this one. We've got a fellow that wrote in and says that he does linear regression channel on IV for 50 days. What do you think about that?
Linear, this guy's a math whiz, right?
I'm guessing.
He's really testing me. I mean, I don't know if I've heard that since college, and that was a long time ago. To be honest, I don't know. I haven't done any studies like that. That's a great question, and I would love to talk to this person. He can reach out to me at trading@protraderstrategies.com, and I would love to discuss that a little bit further. You know, that's one of those ones coming from the outfield that kind of clocked me in the back of the head.
I didn't mean to do. I think what he was thinking about is that you know, he was talking about on Thinkorswim platform. You know, is there a linear regression channel that you can set up on that for 50 days? But anyway, don't want to derail.
There might be, and that's something maybe I should look into. I usually just look at this, and I know that just over my course of trading, you know, all the way back even to when we used to literally on the floor when we would trade options, you know, it was like this. We had it on a piece of paper, the volatility, and if volatility went up by 1 percentage point, we were like flipping our pages like this, and if volatility really spiked, we were like, go up and run me more sheets, you know. So that's how old school I am. So, you know, at the end of the day, what I try to do is streamline it. And if that is a way to streamline the process of determining whether volatility is high or low for a particular underlying, I'm more than willing to put that in my quiver to take a look at.
Sure. And he's just amplifying. He's saying, hey, he just uses it as a way of getting a better understanding of what the percentiles are.
Oh, okay. Right. Yeah. Yeah, I'm going to take a look at that as soon as this is over. I'll take a look at that for sure.
All right.
So somebody also threw over the one that I just saw. Pete was like, what do you call this ratio? I call it the implied volatility percent that's what we used to call it on the floor. Thinkorswim was designed by floor traders. And so they kind of stole it from the floor when they were doing Thinkorswim, which got bought out by TD Ameritrade. Just to give you a little history of that, it was floor traders from the CBOE that started that platform that eventually got bought out by TD Ameritrade. So this is one of those things is we would call it implied volatility percent. And the only reason why is because we could tell when it was at 100 percentile, which we knew premiums were super expensive. And, you know, that was just like the red lights are going off. Implied volatility is through the roof. We don't want to be buying option premium at these levels, right? So, you know, that would affect how we did our bid offers. You know, when you're looking on a platform today, you see the bid offers. Well, we were the guys they would call up and say, hey, what is the quote on this? And, you know, when implied volatility was extremely high, we knew we needed to, you know, adjust our bid offer according to that. So we've always called it implied volatility percent, you know, and being a floor trader, go figure, I went with TD Ameritrade just because I knew the guys who were doing it. As a matter of fact, I know a couple of those guys that do those commercials, which is kind of funny. Anyway, great stories that I could throw them under the bus. And but beyond that, what we want to do is kind of figure this out. So if implied volatility is at elevated levels, then that's where we want to sell premium. And when it's at really low levels, like when it's down here, you know, we can see that, let me go back to this. I got a little, you know, when it's at these low levels down here, that's where we would want to buy premium, okay? Yes, it can go against you a little bit, but so can our directional assumption. But it can go against us a little bit, but we know it wants to revert back to the mean. Whether we're heading into an earnings event where we know volatility is going to start expanding, like that guy I was talking about, you know, he's like, buy your premiums right before that earnings event. Well, no, we want to buy it well ahead of that earnings event, because going into earnings, we can see volatility start spiking, right? That's when we want to buy those premiums, maybe ahead of that, and then get out of that trade before that earnings event happens, because volatility coming out, even if the market moves in your direction, I would say, you know, that's a risk I don't want to take. So what we do is for stocks, we want to buy low. So stocks, we're going to be buying, oh, I'm using my eraser. My pen has an eraser in that thing. So buy when for a stock below 50, all right, or an ETF when it's below 30. Now, I watched the previous guy's chat, and he was talking about ETFs and stuff like that. And he did mention volatility in there. Well, think about with an ETF melding out the kind of movements of all of the underlyings. Well, same thing goes with the volatility. I showed you, even with tech stocks, volatility in those tech stocks is completely different, right? One tech could see volatility spiking while another sees volatility coming out. Well, that's going to meld out the implied volatility percent for this. So for an ETF, it's a little bit lower. It has a tendency to kind of drop below 30 rather quickly, whereas stocks want to kind of stay in the middle there. So if you're buying low, selling high, this is the idea. For somebody that has a little bit higher risk or lower risk tolerance, what I would suggest is maybe, or if you're newer to trading options, kind of look at this one and say, all right, well, I've got a lower risk tolerance, or I'm brand new to trading options. I don't want to get too crazy. You could say when implied volatility percent is below 30, that's when you're going to be buying premium. Or for an ETF below 15, all right? Because that way you won't see those volatility fluctuations, you know, against you as bad, okay? So you could do something like that, or even below 25. Just stay consistent, all right? Because the idea here is we want to stay mechanical. I even think the last guy was talking about staying mechanical by using algos, right? I do the same thing. I have guidelines where we follow in order to implement our option strategy and get out of it to stay mechanical. Because one of the things we want to do here is make sure we take the emotion out of trading, okay? Because whenever you tie something to money, that's an emotional attachment. And what I want to try and teach you guys is get away from that emotional attachment. This is probabilities. That's what we want to do. We want to take out all of the scary and put it into context, you know, like, you know, the thief in the night is we want to take advantage of them sometimes we don't. Make sure that unknown is out in front of you so that you know how to head it off at the pass, if you will, or take a different direction. All right, so buying low, pick your line. I usually say below an IV percent of 50 is where I'm going to be looking to buy option premium, ETF below 30. But absolutely, if you're newer to options trading, you have a lower risk tolerance, you don't like to take a lot of risk, well, then think about buying it when options premiums are super cheap. Okay, it's going to limit your opportunities, but hey, you know, getting your feet wet is the first step before jumping into the water, right? And then further, when you want to sell premium, you want to make sure that that implied volatility percent is above 50. So in the case of BABA that we were looking at there, well, implied volatility was above 50. It's actually at around 64. That's where I would be looking to sell premium in BABA. As a matter of fact, I just did a webinar last week on selling a call spread in BABA because it had high implied volatility. Well, the direction did, obviously, you can see if I was looking at selling it last week, the direction went against me. But with some of that volatility that we came out before just today, you know, I got out of it yesterday, but the volatility coming out of it let me get out for a scratch. My idea was, hey, if it is I'll just go through the chart setup because I'm sure you guys have seen somebody talking about candlestick setups with BABA. Let's go to BABA. Candlestick setups, right? Well, we got a chart set up where we got a bullish pattern here, and then I've got basically a red candle right there, right? Well, that's a confirmation of a top. This before the unknown of yesterday happening. Well, our idea is you get above this candle there, and that's where you want to get out of this trade. I was expecting it to come down and cover this gap. That didn't happen, and that happens in all trades, right? Sometimes the charts don't set up, so it got above here, right? So I'm out of that trade above that high, but you can see that the volatility was coming out of this trade. Well, if I'm selling premium, volatility is came out pretty good, like 4 percentage points, right? That was $1.60. Well, that offset that directional move to the upside there, right? So you can be directionally wrong, and I say a winner is a scratch, especially on a busted setup. So it was basically for a slight loss, but I would say that was a win because I put myself into a position, or a win for me. It wasn't a win for my portfolio, but it was a win for me because I was staying mechanical. It broke above that. I set myself up for success with this strategy. Direction was completely against me, but with that volatility coming out, I was able to offset some of those directionality miscues, if you will. And again, with the stocks of selling high, again, if you have a lower risk tolerance, you could say above, 70, 75%, and kind of say above 50% or something along those lines for an ETF. So feel free to kind of adjust those parameters if you want to for selling premium. But I like to just kind of say, hey, it's above and below the line of delineation. I got my directional assumption in it. If it's above 50, I know I start thinking, all right, I need to start thinking option strategies that I need to sell premium because I want to sell high, buy low, right? Another thing that we do is I've kind of come out with some guidelines. These aren't like really drilling down on the nitty gritty and days to expiration and all of that stuff. But one of the things that we kind of talked about here is I just whipped this thing up is, first thing you ask yourself when you're looking at the specific underlying, right? You've got this underlying. Do you have high implied volatility for that underlying or low IV? Well, if you've got high IV, you kind of move over here, right? Sell high, buy low. Do you have a directional bias? You don't always have to have a directional bias, right? I mean, if you're going to sell an iron condor, you would not have a directional bias, right? I think the directional bias might be, I think it's just going to stay right here, neutral. I have a neutral directional bias. You can think of it that way. And same goes for low. If you have no directional bias, then you'd be looking over at this side, right? But first thing we ask ourselves is, where is volatility? Because if I'm buying or selling, that I need to know where those premiums are. I need to know if this car is expensive or cheap, right? So you go to the Kelley Blue Book, right? Kelley Blue Book kind of gives you where the median price is. You can tell if it's high or tell if it's low. That's what I'm trying to do with this. So if implied volatility is high, you ask yourself, do I have a directional bias? Yes, I do have a directional bias. Or no, this is actually, do I have high volatility or directional bias? Yes. You go to this side. Next question you have, do I have margin requirements? Well, this kind of leans towards margin requirements. Is that an issue? Do you have a smaller portfolio, right? Or am I in an ETF? That's going to be the yes side. The no side, you flip over to the other. You can go to the naked calls. If you're not worried, you have a higher risk tolerance, you could look at margin requirements as a higher risk tolerance, things of that nature. And it's going to kind of determine your strategy, right? Short call, that we haven't talked about our directional bias, whether it's bullish or bearish. You know, that's going to be your next question. Is that directional bias bearish? Well, then you would sell a short call or short call spread. Yeah, for members, we do have this, this is where we can send this out to you in a portfolio type, or send you this out as a hard copy. I don't have a hard copy that I can set a link up for right now. You'll have to reach out to us on that. I see that question from Al, or AI, Al. So basically, this is what we've kind of done throughout all of my webinars, where we have guidelines, you know, where, you know, and I'll drill down on short. As a matter of fact, the next one is on a short call, right? So what we're going to do is we go through these guidelines of setting it up for the path, roadmap to trading options is what we're calling this one. And basically we start out and we go through our progression when we come up with a directional assumption, however you come up with it, whether you've got a service or you're looking at the Fibonacci's or however that happens, we come up with a directional assumption on any given occasion. Well, I don't always believe that anybody has the best directional assumptions, including myself. But what I do is try and turn those probabilities in my favor, so I can be directionally wrong. You know, I've been directionally wrong my whole career in a lot of cases, right? But I'm still around after 25 years and I've never had a negative year. So, you know, that's because I turn the tables in my favor. I make sure I've got the probabilities in my favor and set myself up for success. One of the few things we can do to be successful in trading, you guys, is make sure you're setting yourself up for success at the onstart, all right? And, you know, taking the emotion out of it, because the last thing we want to do is be emotional traders. The psychology of trading, I talk a lot about my stuff too. I actually started out with a psychology degree, believe it or not. Started trading in college. I mentioned that, but switched over to finance before moving to Chicago. And I always say my psychology degree probably was more beneficial to trading on the floor than my financial degree. Other than telling other traders what the ISM number, which back in the day, I'll date myself, used to be called the napalm, and they probably changed that because of napalm or something. I don't know why they changed it, but they did, to ISM. They would ask me what that number really meant. And that's one of my favorite numbers because it's forward looking. Somebody said, is it for buying stock or options of the stock when IV is less than 50%? Thanks. For options. So buying stock, when you're buying a stock or selling a stock, the volatility really doesn't matter, other than it gives you an indication this thing could move, you know, 10 points in a given day, right? When we looked at Tesla being like a 123, that I believe means that Tesla can move almost upwards of $100 within that duration of those options. So, you know, so we're looking at some odd days. So Tesla could be moving by the end of 43 days, 100 points. Well, we saw him move 70 points today, so it's pretty dead on. As a matter of fact, one of the a little hack that they've got for you now is that you can see what the movement could be. $43, $46. That's saying plus or minus $46 for BABA in the next 44 days, right? This premium saying it could be plus or minus $76 in the next 100 days. Just a hack there for you. Anybody else have any other questions? Rolly, are you seeing any on your other one?
No, just a lot of very positive comments on the flow chart that you put out there. The decision-making tree that you put together just did a wonderful job of just kind of coalescing everything that you were talking about.
Yeah,
so
whip that up in Google Docs.
No, but seriously, it just captured that thought process, and it's like, all right, this brings it all together. This is it is somewhat mechanical from that perspective, but that's what you're and you and so many of the speakers have just been talking about. You have to have rules and guidelines that you're tested and you're comfortable with, and a decision tree like that takes a lot of emotion out of the
Yeah, it definitely does. And then in the webinars, like these webinars and the courses that I do, we drill down on each one of those strategies. Whether it's the short call, long call, when do we lean towards that specific strategy, and then we know explicitly which days to expiration we're going to be looking at to optimize or defer our theta decay, right? That thief in the night, strike location, all of that stuff. So we really narrow it down, and then I kind of go into it like I did here as to what my thinking is as to why we're picking that versus, the risk reward we need to make sure, our collection of credit is versus the spread, the width of the spread, all of those things. I have guidelines for people so that, it takes the guesswork out of it. You're like, am I picking the right strikes? Why am I picking, Wolfman, why are you picking these strikes? Well, I'll tell you exactly why I'm picking those strikes in those webinars. I mean, I don't have enough time to go through it all right now, even though we are finishing up, but I don't think I can get it done in 10 minutes for everybody. So I'll wrap it up a little bit earlier if there's no other questions, but this is our course for trading earnings. And this is specific to you guys. So people can take advantage of this for 36 bucks. If you listen to that guy from Goldman Sachs, you'd lose more than $36 on buying a call for an option for earnings, I should say. So we'll save you money there. For 36 bucks. You're going to basically get not only, we are in earnings season right now. We're heading out of it a little bit, but we also have the options. Strategies for setting up for the next round of earnings as well. So, if you like a stock long term like Tesla or something, and you want to trade those next earnings, then we have strategies to set you up for that going forward.
Well, there's a couple other questions I'd like to pose with you as we close. One of them is that a couple of people asked for is that as we think through how you approach the market, from your standpoint, personally, Eric, when you wake up in the morning and you're getting ready to trade, how do you look at the market? Do you have a scanner? Do you have things that you're focused on? Given the choices that you have.
Yeah. So first thing I do when I come in the morning, I'll pull up. Hopefully this doesn't. Let's see there. First thing I do every day is I do this, and Forex Factory is my go-to for, I think they have the easiest to kind of follow. I look at the economic data and just kind of see where things are, right? And then I'll drill down on them. Like we had a crude oil inventory draw today, so that's going to lean you towards bullishness, right? Well, I actually drill into that. The reason why there's a big draw is because we had those hurricanes, they shut down. So there's lack of supply coming into the market. So, so I started looking at those different things, factory orders, we've been seeing with the ISM, the ISM, Institute for Supply Management, PMI. This is my favorite number because it's Purchasing Managers Index. We got to look at what the purchasing managers are forward looking. And
Sure.
so if those guys are very bullish, which, you know, anything above 50 is expansion, then that's bullish in the economy kind of thing. So that leads me to believe that things are starting to pick up here, despite the fact that we're seeing Corona. And then literally I go through and I start looking for opportunities. So like I said, I have over here on my watch list, IV percent. You can see that
Okay.
I put it in, not in any given order by stock or pricing or anything else. It's by implied volatility percent. So I will go to the charts and be like, you know, I know I would be selling premium here, and, you know, Slack would be something, right? I just see it kind of, you know, whether you have your Fibonacci's, I'll throw Fibonacci's up there. Hopefully, of course, I've got it on a Fibonacci retracement or extension. So I'll just.
This is where you're picking up your directional bias. I mean.
Yeah. So like if you know, for instance, it bounced off of there, so I would be bearish in this, right? And I know I've got high premium in it. So if I could get above 40 for me, selling Slack, you know, that gives me 2 resistance areas. I would say that I'd be looking to sell premium in there. And I definitely would. So, you know, one of my guidelines here would be, I want to take advantage of that thief in the night. So I want to get close to 35 days to expiration. Well, Slack, we can get really far away with these 40 days to expiration. So I would be leaning towards trying to even go to like this 55 area to sell that premium. So that would be something
Sure.
I might even put on tomorrow. Who knows? So that's kind of how I come up with mine. But I don't even know what the underlying is when I'm looking at it. If I saw this chart set up also, right? We got that big candle right there that looks pretty bearish. That would be something I'd put on my radar. I know it's high premium, so I'd be looking to sell it, you know. And then I just literally flip through all of them. I don't even look up here. I'm just kind of looking for chart setups or Fibonacci's and stuff.
That makes sense, because you're looking for something that's really going to catch your eye.
Yes.
You know,
I look for something that's really going to jump out at me. And all of these stocks on my watch list fit some of my other guidelines that I have for trading options. And that has to do with the tight bid ask. And one thing I want to talk about with that is we have to know that there's a lot of volume and open interest. There's got to be a lot of eyeballs on the options in order to trade them, because, you know, AutoZone, everybody's heard about it, but nobody likes to trade the options in AutoZone. So I don't want to go into a room where there's just one guy. You know, I want to go into the room where everybody is selling apples and there's about 20 different tents, right, set up with apples, and I can just be like, okay, where can I get my cheapest apples, right?
right.
Or I want to be the guy that, you know, there's free market price discovery going on in the options that I'm trading. So,
Well, that's, and there's another question that's come in here. This will wrap things up for us. But James says, do you think that the IV is abnormally high right now, given the market's rising? And is there a risk in that?
Well, there's always risk in it. Do I think that, like, we pulled up the chart of the VIX? I seriously don't think we're going to see an 85 VIX by the end of 2020. So I'm not worried about that, and I'm definitely not worried about it in the next couple of months. Now, will we see 30s again? That's quite possible.
Mm-hmm.
So that's not out of the woods. What are the risks that this coronavirus really starts mutating, right? Or there's a new H2N2 instead of the H1N1, right? So there's always risks there, but what we want to do is try and set ourselves up for the when volatility is at its highest for those underlyings. You know, like UPS, we could say that even back in 2020 or 2019, you know, without all of this was a crazy time. Like we all thought we were going to die, right? And now we're seeing that that's not really the case. As long as we're not putting people in old folks' homes, it's actually pretty manageable. So yes, we will see volatility spikes, but when it would get up, like say for a UPS, if it got up in the 44 IV implied volatility, that would be something where I would say it's at extreme levels.
Okay.
You know, something we used to say on the floor was when there was blood in the water, that's the time to go fishing, you know?
Sure. And that, you know, and to that point, one question I just have personally, because you've reflected many times on your floor experience, do you miss trading on the floor?
Oh, yeah. I mean, literally, if you ever walk on the floor of any exchange, like literally the hair, I mean, I'm even talking about the hair on my arms is rising, you know, like you could feel the energy in there, and you could feel the energy, like you could feel the volatility rise in
Sure.
the room without even seeing it. But yeah, you could feel like a wave of energy coming in and people getting amped, and it wasn't even the sound, it was just the tension around everybody, especially around numbers and stuff like that. And yeah, I mean, I miss it every day. You're in a room full of people, and you know, you joke and talk and you know, tease people, and then all of a sudden, you know, get down to business and
Sure.
and trade, make money. So yeah, anybody, you ever ask that question to anybody, there's not going to be a single person that was a floor trader that would ever say, no, I don't miss it at all. If
Well,
he
we're
said
going
he
to
doesn't miss it at all, he wasn't in the pits.
well, we're going to have a separate webinar where you come on and tell us some of the backstories that you've alluded with some of the characters and people.
Oh, definitely. I
that
definitely
you
will.
know. Eric, thank
Absolutely.
you. Thank you so much for your time
I
today and for
appreciate it.
sharing this information. And folks, I hope you really appreciate, you know, how he's rolled up his sleeve and really share how he looks at the markets, bringing up the charts, you know, the philosophy, the approach that he takes step by step. Once again, Eric, thank you very much. And I wish you, I'm going to grab the slide here and just wish you a pleasant evening, my friend. Great seeing you again.
Thanks, Rolly. Pat, Nikki, great to see you guys. Thanks for having me.
So folks, once again, Eric Wilkinson, Wolfman is his nickname with Pro Trader Strategies. His special offer for the Wolfman's Options course, best strategies for trading earnings of every for your favorite stocks, a technique around that, finding the optimal strike location heading into an earnings season, when, where, and why options are best way to trade stocks. And that's a heavily discounted course for $36. You can go to westmarktrading.com/M9-Pro and jump on that special offer, and go to protradingstrategies.com to find out more about Eric and the team at that company. They do a fantastic job, totally dedicated to education. So once again, we appreciate him being here, and that brings us to the top of the hour.